we know that we do a lot of somersaults when it comes to policies within the African continent, just like Sisi had alluded to. So within the VC space, I mean, you would because these are private markets, and you have enormous funds that go into this project or these ventures. Then you now have a policy redirection or a change in governance and all that. How do you mitigate against that, especially when you're looking at investment that have been made by families or wealthy individuals, or if not, it could even be investment made by other funds that have been raised and all that, but you just have this change in direction and the whole thing just comes unraveling. So how do you manage that?
Of course. I mean, I think to a large extent, it's planning rather than adapting to an event, Messi. I think what really comes down to a good family advisor or good fund manager as well is the ability to think ahead, the ability to think ahead and to predict what might happen, right? I think just speaking back to the earlier point, for example, I think for most individuals who are associated with managing Russian wealth, it didn't come as an entire shock. It was not like Russia decided, woke up, next day there was war and nobody was talking about it. Anybody who took preventative measures, who was aware of the geopolitical situation or who followed the news in Ukraine since about 2012 had the 10-year window to take adequate preparations, both to protect their capital, to protect their clients' capital, and to diversify as far as necessary. I'd say the same really goes to VC funds and private equity funds. Private equity funds and VC funds have an advantage and a disadvantage in that the money that they invest is incredibly illiquid. It's money that is no longer directly controlled by them. It cannot be pulled out of that investment, and that both means there is a good and bad thing to this. The good thing is that even if regulations change, if the regulations governing fund structure change, the regulations related to the way that trusts have to or don't have to disclose particular investments change, almost always these apply only proactively going forward rather than to retroactive investments, which mean that private equity and VC funds are largely protected based on their past behavior. At the same time, the structure of private equity and venture capital funds often protect their backers as well. So thinking about the family office world in connection to VC and PE, the whole aspect of limited partnership agreements exists on the basis of protecting the interests of that limited partner, of that HNI, of that family office that backs the VC, where they only are responsible for a limited degree of involvement to that VC. That protects them from any change in regulation that might somehow damage LPs in the future. It protects them from any risks or illicit behavior that the fund might take, which in itself is relatively unlikely, and it sometimes even can provide downside protection. The final point I'll say on this is actually globally, speaking more widely, if we look at the US, the European, the African, Southeast Asian, and the East Asian private equity and VC landscape, it's looking pretty good. It's never been as free of an environment to operate as it is now. There are a lot more sectors that are still largely unregulated, but regulation can sometimes be a positive influence. And there are a lot of countries now that are looking into providing support for reducing capital gains and creating more investment incentives to back private equity or VC investments, especially on the African continent, where we've seen about 8 or 9 countries pass more startup-friendly and investor-friendly policies just in the last 3 years alone. So, I think regulation and adaptation to all of these things is just about thinking proactively of the risks you're taking and preparing yourselves for the opportunities that might come up.